Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, January 15th. The major economies, including the US and Britain, are revealing their latest inflation updates today amid a global sell-off in sovereign bond markets due to their exploding debt levels and rising inflation expectations. So the volatility is rising and worries are mounting. So sentiment was slightly better and the US dollar was slightly lower yesterday on the back of a softer than expected PPI report from the US and also on news that Donald Trump's new America First team would only gradually increase tariffs on the rest of the world, if that's any comfort to anyone. Now, diving deeper, the US core PPI unexpectedly remained steady at the 3.5% level last month, and the headline PPI jumped from 3 to 3.3% instead of jumping to 3.5% as penciled in by analysts. But many components in that report that feed into the Fed's PCE index were mixed. Energy prices, for example, surged by 3.5% due to an almost 10% rise in gasoline prices. Transportation and warehousing services saw price increases as well, while food prices fell by 0.1% with fresh and dry vegetables down almost 15% last month, and service prices remained flat overall. As such, while yesterday's PPI data helped cooling inflationary worries but didn't meaningfully reverse them. So the US 2-year yield eased to 4.36% mark, while the US 10-year yield flirted with the 4.80% level for the second straight session. The US dollar eased across the board amid the rising hopes that the implementation of new tariffs from Donald Trump's new team will be less dramatic than investors initially feared, and the euro dollar was also boosted, for example, by a surprise rebound that we saw in the Italian manufacturing last November. But the pair is seeing resistance near the 103 offers this morning into the US inflation report that's due later today. So in numbers, the headline inflation in the US is expected to have ticked higher from 2.7 to 2.9% in December, while core inflation in the US is seen super sticky near the 3.3% level. A higher than expected set of inflation data from the US today could reverse yesterday's sell-off in the US dollar and weigh on treasuries and on equities, while a softer than expected set of figures could help cooling the hawkish pressures on the Fed and let the US dollar give back field and the treasuries and equities take a breather. But given how hawkish the Federal Reserve expectations have become recently, a soft-looking set of data could have a greater impact on the market in terms of price action today. But in all cases, market volatility will likely be on the menu du jour. According to Citigroup, the S&P 500 could move 1% up or down after the CPI data released today based on the pricing of the at-the-money put and call options, and that's competing with the Federal Reserve's next rate decision day. And it's also apparently higher than the volatility implied for the US next jobs day. In other words, the stakes are high today. The S&P 500 actually closed yesterday's trading session slightly up and above its 100-day moving average. The CPI data today will either keep the index above this 100-day moving average level or send it below sustainably. Also on the menu today, the US bank earnings, mind you, they are expected to print a 40% growth in earnings in the fourth quarter of last year altogether, thanks to comfortable comparison to the fourth quarter of the year before. Robust net interest income for the big banks and improved trading activity could also boost the revenues of the big banks, and that's something that we are going to be watching this week. Elsewhere, the Eurozone countries are also releasing fresh updates to their own inflation numbers today, with the Eurozone's aggregate figure for December due this Friday. Meanwhile, the UK just printed freshly this morning a set of lower than expected inflation figures. So the UK's monthly core and headline inflation numbers ticked higher in December, but they came in lower than penciled in by analysts. While the yearly inflation figures in the UK fell for both readings, both core and headline readings, giving the Bank of England more context or more room to provide relief to the UK's renewed debt aches if that's needed. And well, note that yesterday's bond sell-off in the UK went surprisingly well. It was actually the first major bond issuance from the UK since last week's debt drama, and the £1 billion worth of 30-year bond auction of the UK yesterday was 3 times oversubscribed. So the letter looked like it could eventually cool down the downside pressure that we see in the gilt market today, but unfortunately the 30-year gilt yield rebounded while the 10-year yield is back testing the 4.90% level this morning. So that means that Rachel Reeves hasn't yet convinced global investors that the gilt sell-off that we see these days is nothing meaningfully more than the global bond sell-off that we see elsewhere as well, and that her spending cut plans will be enough to get the budget plans right. But the market's unwillingness, the clear unwillingness to fund her spending plans are obviously waiting on the British growth outlook and also on sterling's valuation beyond the global pressure that we see on the government bond space. In the sense, cable cleared the 1.22 support this morning after the release of the latest inflation figures. The outlook for sterling remains bearish, and that remains bearish on political uncertainties for Britain and also on expectations of some Bank of England support moving forward. Now, note that we are at levels well above the Liz Truss times in cable, where the pair had dived to 103.50 level. Remember that? But the market reaction to Truss actually gives us an idea on how bad the things could get in a short period of time and exacerbate the situation. So in summary, I think that there is a chance that things will get worse in the UK before they get better. Across the channel, the new French Prime Minister, Mr. François Bayrou, is walking on a tightrope as well by giving some important concessions on the heated pension reform for France and the deficit target to avoid losing France's divided government support and face the exact same and sad fate than his predecessor Michel Barnier, who could hold on to his position only 3 months, remember. But being the French Prime Minister today is like riding a rodeo bull. It's not really a good thing to do. The rise of the French yields could equally be put on the back of the global bond sell-off, obviously, but at the end of the day, what we see is that we're always coming down to the same exact story in most developed economies. High and rising debt levels and slow progress and even a U-turn for some economies in the inflation figures that suggest a higher inflation levels in the medium to long run that obviously pushes the yields higher. Now, note that yields used to be higher than where they are today before the global financial crisis, and the latter didn't necessarily prevent economies from performing well and thriving. But note that the rising volatility in the borrowing cost is not ideal, and that the rising volatility rather than the rising levels could weigh on the global risk appetite moving forward. Now, one good news in all this is that Israel and Hamas are reportedly nearing a ceasefire agreement before Donald Trump's inauguration day next week. The latter actually helped cooling the rally that we see on the US crude prices into the $80 per barrel level yesterday, as Brent crude is below the $80 per barrel level itself. But note that things there may not be as rosy as they might seem at the first glance, because some experts out there warn that Israel may be easing pressure in Gaza to strengthen its ties with the US government to increase pressure on Iran, which is another major oil exporter, mind you, with around 1.6 million barrels per day exported in October last year. So what I'm trying to say is that the geopolitical tensions are here to keep the upside risk alive in oil prices, both on the Russian and the Middle Eastern front. So in numbers, minor support here is seen near the $76 per barrel level in the US crude, which is the minor 23.6% Fibonacci retracement on the latest rally, while the major support stand near the $75.40 per barrel level, which is the 200-day moving average, and the $74.30 per barrel mark, which is the major 38.2% Fibonacci retracement, and which should distinguish between the actual positive trend in oil prices and an eventual medium-term bearish reversal. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.